Thanks so much for joining us on this special edition of Bloomberg Daybreak. U.S. markets are closed for the Memorial Day holiday. I'm Nathan Hager, and coming up this hour, will the Fed cut rates this year? And if so, when? And just how strong is the U.S. economy? We'll have a roundtable discussion with Michael McKee, our international economics and policy correspondent, and Bloomberg Economics chief U.S. economist, Anna Wong. Plus, Memorial Day unofficially kicks off the summer. Are there any good travel deals to be had? We'll ask the founder of the Points Guy, Brian Kelly. But first, let's take a look at the direction of travel for the stock market. Equities hit all-time highs earlier this month. In fact, the Dow Jones Industrial Average crossed 40,000 for the first time. Plenty of analysts are racing to adjust price targets for the broader indexes. So what's in store for the rest of the year? Let's discuss with two expert voices on this market. Alicia Levine is with us, head of investment strategy at BNY Mellon, along with Brian Levitt, the global market strategist at Invesco. Thanks to both of you for being with us. Of course, stocks have certainly defied expectations from the start of the year. So Alicia, I'll start with you. Where do you see the momentum right now?
So I think the momentum is really coming from the micro side, which is earnings. And then, of course, the macro side, which is the data, are holding in better than feared 12 months ago, 6 months ago. And the U.S. economy is not overheated, and it's slowing down in a way that allows the Fed not to have a hiking bias. And so, therefore, we just think it's a pretty good place to be. There is the possibility of volatility around the election, of course, and other hot data prints we might get on the inflation side, which really is the most important thing right now for where yields go. But other than that, we think the overall picture looks very good. So we'd say the negative side of sort of left tail risks, not that they're nothing, but they're not as big as they were, let's say, call it a year ago. And so we look at the world and we say this kind of feels a little bit like the 1990s, where good enough growth, rates have normalized, we can grow from here, and the economy is humming.
Let's take that point, Brian. Looking like the 1990s, we saw a bubble back then. Is this a market that could see a bubble start to burst?
Well, the late 1990s, we saw a bubble. So I think what was being referenced there is perhaps more the mid-90s. We did see the Greenspan Fed back then raise interest rates in the mid-90s by a pretty significant amount. The market didn't love it, although I don't think an 8-9% decline is anything terrible. But when it became clear that the Federal Reserve could back off, that the economy was still strong, the proverbial soft landing of such, that it ended up being a very nice number of years for markets beyond it. So I don't think Alicia was mentioning it to suggest that this is a market that's in a bubble, more that there's a nice setup for markets to continue to climb higher. And if it is 1994 or 1995, investors would then be quite happy over the next few years.
Of course, Alicia, you set up a pretty strong bullish outlook there with the setup just now. How much further upside do you see for this market? What's going to be the catalyst for where things go for the second half?
So I think the catalyst clearly has to come from the earnings side. I think the excitement over AI and sort of fellow travelers, so the hyperscalers of the Magnificent Seven, plus the chip beneficiaries, plus the power of the utility beneficiaries, that feels like it's well locked into place, and it's not an unknown, right? It's not an unknown. So I think you have to have earnings come in from the rest of the market. I think it's clear that another hot inflation print could cause volatility here. We would expect something like that. I think the models for predicting inflation are clearly not working. And that's okay, but it does look like we're sort of in this disinflationary period with some hiccups here or there. So that could cause some volatility in the bond market. Overall, what we've been saying is the Fed pivoted in December. We don't think the Fed pivots from the pivot. So in terms of rate cuts this year, we've always said less and later. We're really at one cut for the year. That would be sufficient to keep the market moving higher into the end of the year. And let's just point out, Nathan, we're in a re-election year, and administrations tend to do everything they can to get reelected. And I think we see that with some fiscal support. So I think it's just very hard if you just put a timeline on this. Even though as strategists, Brian knows well, you don't put a number and a date in the same sentence. I just think that it's just hard to get that deep sell-off from here into the end of the year in a re-election year with the setup that we have of 2 to 3% growth and inflation that it possibly sticky, but still on the downward trend.
I want to pick up to something that Alicia talked about at the beginning in terms of companies meeting their expectations for earnings. We've gotten through most of the earnings season, Brian, and I've seen a lot of these companies put out pretty strong forecasts, some pretty positive outlooks in terms of where they see things going. Do you think companies are going to be able to meet or exceed their earnings expectations heading into the second half? What's it going to take for them to do it?
And so far, they've been able to, and this was, again, to your point, another good earnings season at a time when, many investors a year or two ago were thinking a recession was coming and were contemplating what a decline in earnings could look like. So it's an economic backdrop both in the U.S. and globally that continues to be supportive for corporate earnings. The irony in all of it, Nathan, is that for all the focus on the Fed and for all the focus on will they or won't they and by how much and when, the reality is that good nominal growth and no rate cuts is just fine for markets. In fact, perhaps may be preferable to weaker growth and lower rates, which is what a lot of investors had been expecting.
Speaking with Brian Levitt, Invesco's global market strategist, and Alicia Levine, the head of investment strategy at BNY Mellon. Interesting point Brian had just there, Alicia, about the setup still being positive for companies, even if we don't see a Fed rate cut this year. Do you share that view? Is there really that much of an expectation from companies that the Fed needs to deliver in order for the momentum to continue for stocks?
So for 30% of the S&P, which is about the top 10 stocks, they don't need to borrow. So what the Fed does in some ways is not relevant to their business models. Where you feel it, whether the Fed cuts or not, is as you go down cap into small cap. A lot of the small cap index, over half, has floating rate debt that's due much sooner than the fixed rate debt that the larger cap companies took out in 2020 and 2021 when rates were near zero. So that's why the Russell, for instance, is still 15% below its all-time high in 2021, because you do have some business models that could be threatened here. Overall, the S&P is more resilient to what the Fed decides to do with rate cuts if the Fed stays here, which is very possible. A lot of the debt in the S&P is fixed rate and not maturing until 2030 or later. So it's just a structural change. And so I think this kind of obsession with the Fed is nice. But to Brian's point, when the Fed cuts many times, it means that the economy is weak, we have higher unemployment, and we're headed into a recession or we're already there. So I think most of us as strategists would take, 5 to 5.5% nominal growth with, a Fed funds rate meeting that more or less. And don't forget, earnings are nominal and the S&P reflects nominal growth. And so you are, in a sense, already participating in all those parts of the market that you may be a little worried about with higher rates, as long as your companies don't have to go out and tap the debt markets.
Brian, I want to pick up on another point you had earlier about looking beyond the U.S. market. We've been talking about the resiliency of the U.S. economy, but the potential as well for some other opportunities outside the U.S. Where are you looking? Where are you advising clients to put their attention when it comes to ex-U.S. investments?
Yeah, and investors clearly have preferred the United States for a variety of reasons. The catalysts that tend to unlock the value in other parts of the world will either come from economic surprises or will come from policy changes. So if you look at places like China or in Europe or in the UK where valuations are more reasonable, are there catalysts? And you're seeing policy that likely moves ahead of where we are in the U.S. in terms of supporting the economy. You've seen China take some steps now to support their property sector. The European and UK central banks may be lowering rates ahead of time. But what you're also seeing is those parts of the world that were hit harder over the last year or so are now starting to surprise to the upside a bit, while the U.S. surprise indices in terms of whether we're outpacing economic expectations are coming down a little bit. So it's a sea change. It's not necessarily one where we say go out and swing wildly to move from the U.S. to international. But if you believe we're in the recovery phase of the cycle in those parts of the world, then you would want to increase exposure. Will help the valuation of the portfolio, diversify some of your dollar exposure. And if we're right that those economies are recovering, tends to be a good backdrop for their markets.
And Alicia, I'm curious where you're looking for surprises. I mean, we've got wars still happening around the world. We've got a U.S. presidential election coming up in the fall. We've got a U.K. election coming up in the summer. What's got your attention?
So is this the question about what makes me worry at night?
What makes you worry at night, Alicia
Okay.
Levine?
So, look, I think the geopolitical risks are very real and heightened in a way that, typically markets don't really factor in geopolitical risk for more than a few weeks at a time. I think, and typically it's through the commodity cycle. So, Ukraine, Middle East, clearly oil, and in the Ukraine case, fertilizer, and for food, that could be still at risk there. But the market knows that. And in fact, WTI oil prices have actually come down from the peak when there was probably a $10 premium in oil prices for a hot war in the Middle East. I think, maybe there's some volatility around the election. And I would say this, I think the best thing that can happen for all of us is that we wake up or we go to sleep with a 53-47 win for whatever party it is, and it's a clear winner. And I think that would be the best case for the market regardless. I think if we have one of those where it's really too close to call and may take weeks to find out, that's not great. And that won't be great for the market either. And so that's just, I think, probably the risk out there. The other thing is the deficit, of course. Neither party is really serious about addressing this. And in fact, both platforms have enormous fiscal spend attached to their political promises. So I'd say that's something we have to keep an eye on.
Our thanks to Alicia Levine, Head of Investment Strategy at BNY Mellon, and Invesco Global Market Strategist Brian Levitt. And coming up next, we'll take an even closer look at the economy and whether the Fed will cut interest rates before this year is out. I'm Nathan Hager, and this is Bloomberg. Welcome back to this special edition of Bloomberg Daybreak. U.S. markets are closed for Memorial Day. I'm Nathan Hager. Thanks for joining us. Now we want to turn from the stock market to the economy. 2024 began with high expectations for interest rate cuts. So far, we haven't had a one. So, what will it take for the Fed to finally pull the trigger, and will they even do it? To dive into those questions, we have convened a special economic roundtable. Anna Wong is with us, Chief U.S. Economist at Bloomberg Economics, along with Michael McKee, International Economics and Policy Correspondent for Bloomberg Radio and Television. Thanks to both of you for being with us. And I'll start with you, Mike, because you talk with these FOMC voters like all the time. So what are they telling you in terms of policy?
Basically, their story hasn't changed. They're waiting for inflation to show signs that it is going to continue on down to 2%. Now, one important thing to remember is they're going to start cutting interest rates before they get to 2%. They've made that clear. But right now, they're not seeing any progress at all since basically inflation has stalled out. So it's going to take a little while, several more months, and then we'll see whether they get anything this year or not. A lot of them moving out sort of on the curve, and more and more of them talking about end of the year as a possible first timing for a rate cut.
several more months. Anna, of course, you worked as an economist in the Federal Reserve. And it's so funny because at the beginning of the year, there was all this talk about maybe 6 or 7 interest rate cuts. Now, there's no way we can get that the way the calendar is going. So what do policymakers need to see to get that assurance that they can start the interest rate cutting cycle?
Yeah, so, in the beginning of the year, when the market was pricing in 170 basis point of rate cuts, that was a little bit overdoing it. But even then, at that time, given the inflation trajectory, a fair assessment, given the, inertial Taylor rule, which the Fed has followed quite closely over the past 2 years, is that 100 to 125 basis cut was reasonable. And now we are down to the model, the Taylor rule, is saying that a fair assessment would be 40 basis point of cuts, and that would be the result from a reasonable range of inflation numbers. And the reason why that rule has come down from 125 to now 40 is because mostly because of the inflation data, as you suggested. So I think the expectation that the Fed will cut once or twice this year is still fair. And whether it would be more like 1 cut or 2 cut, it depends on whether inflation is going to be closer to ending the year closer to 2.6% or is it 3%. So in our forecast, we do expect inflation to be drifting back up from a low of 2.7% mid-year to closer to 3% by the end of the year. But we still do think the Fed would cut because unemployment we think it's going to rise about 4% by the end of this year.
Mike, from what you're hearing from Fed officials, are they feeling that pressure to deliver the first cut before the year is out? I mean, it does get harder to make that move once we get closer to an election, doesn't it?
They would argue no, and past history supports that idea that the election doesn't make any difference to them. They'll do what they think they should do when the time comes. But at this point, they don't seem to be feeling any pressure because the economy is not demanding it. They look around and they see where unemployment is well below 4%, and they see the economy growing basically at potential, and they don't think they need to cut rates at the moment. The biggest concern they have going forward is that if inflation does start to fall again, then you get a rise in real rates, and that would tighten conditions even more. So maybe they don't want that. The other side of that coin is, do they need to cut rates because the economy slows so much? And that's not in anybody's forecast there at the moment.
Well, so what is the forecast, Anna, when it comes to the path for disinflation? Obviously, we did see that little bit of a bump the first quarter of this year. Things, as you said, have been stalling out. Where do you see the disinflationary path going, if at all, into the second half?
Typically, in the beginning of the year, you do have these unfavorable seasonal factors. And for this year, this unfavorable seasonal factors for inflation lasted beyond February, which is a little bit unusual. But then if the past is a guide, from here on out to the end of summer should be a favorable period for disinflation. So our forecast, and I think the Fed's forecast, is for the year-over-year core PCE deflator to continue to edge down from now to mid-year. Possibly by August, we will see a core PCE 12-month change of 2.7 or 2.6%. But our forecast for the second half is more pessimistic, because then all these favorable factors we see from here to end of summer will reverse, and then it gets harder. And that's when we also think that the base effects of inflation would turn against all these measures, because last year, the second half of last year was very favorable for inflation. So you have this low base effect, which tends to push up the year over year in the second half. And this is why we think that at the end of the year, core PCE deflator would be closer to 3 than mid twos.
Speaking with Anna Wong, the chief U.S. economist at Bloomberg Economics, and our Bloomberg International Economics and Policy correspondent, Michael McKee. Mike, you've been talking, of course, to Fed officials. We've heard from Raphael Bostic of the Atlanta Fed talking about how there are active discussions about where the neutral rate is, the rate at which policy neither slows nor grows the economy. What's the thinking about where that stands right now?
Well, it's becoming more important because now we're getting into the possibility of rate cuts. And so the question for everybody is, once they do start, how far do they cut? And I think most Fed officials would tell you they don't really know. They don't think they will be going back anywhere near the zero rates that we had for a while. But how fast can the economy grow right now? That's not clear. And unfortunately, the neutral rate is something that's not observable as an individual number. It's something better seen in hindsight. But they're looking at the inflation rate, and they're looking at the growth rate, and they're thinking maybe we have seen the economy move up its neutral rate. But would that last? As Anna said, forecasts are we're going to see a cooling as we go along. So they don't really have a good number yet. They're thinking in terms of somewhere around 4%, maybe a little higher, a little lower. But it's going to depend on the conditions in the economy at the time, and that's going to be several rate cuts down the road. So we probably won't get a neutral rate view until sometime next year.
And when it comes to conditions in the economy, Anna, is there some thinking within the Fed or among economists like yourself that there may need to be some further damage to the economy to get inflation to the Fed's target in terms of the labor market, in terms of goods and services?
I think from reading the public communications of the Fed, it's pretty clear to me that the Fed has moved away from that view that you do need damages to the labor market to bring down inflation. In fact, the confidence within the committee has been building that you don't need that. They are banking on productivity growth and also immigration to provide support to the economy without introducing inflationary forces.
And there's a lot of discussion as well about whether the 2% inflation target even makes sense. I mean, we hear from the likes of Mohamed El-Arian saying that level is arbitrary. Mike, why is it so important for this Fed to get to that 2% target?
It's basically a credibility issue for them. One of the things that was pointed out at the Atlanta Fed conference last week was that during the great inflation of the 1970s and 80s, inflation expectations soared along with the inflation rate, and that didn't happen this time. And so they credit Fed credibility. People believe the Fed will do what it takes to bring inflation down. And they have the 2% target, so they need to stick to that. They need to make sure people understand that they're going to fight inflation. They're going to bring it down. We may never actually get there because they will start cutting before they get to 2%. And if inflation gets sticky at 2.3%, I don't think they're going to risk damaging the economy by trying to push even harder. But they want people to know they're going to follow up. Now, they start later this year a review of their policy framework, probably take another year. And so sometime in 2025 or early 2026, they may change their view. Right now, I haven't found any support for changing it to a higher number, at least firmly. But there are people who are thinking about it, that this world we're going into post-pandemic is going to have a little bit faster inflation on a regular basis. But they're not ready to commit to anything yet.
Well, what do you think, Anna? Is a 2% inflation target still achievable? I mean, it's taken quite a while just to get to where we are right now.
Yeah, I think our view is that inflation is sliding down the nonlinear and steep part of the Phillips curve or the Beveridge curve, and we're about getting to that part where it starts to get harder to generate a percentage point of disinflation, which is what we need right now. We need another percentage point of disinflation. And we won't know exactly whether that's right, whether we are indeed stuck at 3% inflation until 2025 or 2026. And as Mike said, and that's when only the sentiment today is that the Fed is definitely sticking with the 2% mandate, price stability mandate. But in 2025 and 2026, it will be very clear whether inflation is indeed stuck. So from my view, I've looked at a range of models and also looked at bottom up way of looking at inflation forecast. I do think that there's a hard mile to inflation. It might not be a whole percentage point, but it's very likely that inflation, core PCE deflator, could be stuck at 2.7% or above. And the Fed might decide to live with it, even though verbally they would say they are still trying to achieve the 2%, because it is very hard to get from 2.7 to 2%.
Yeah, we've certainly seen how hard it's been just to get to where we are right now. Thank you to the both of you for joining us. Michael McKee, international economics and policy correspondent for Bloomberg Radio and Television, and Anna Wong, chief U.S. economist at Bloomberg Economics. Up next, if you're still looking for travel deals this summer, we'll check in with the points guy, Brian Kelly, on this kickoff weekend for summer getaways. It's 37 minutes past the hour. I'm Nathan Hager, and this is Bloomberg. Thanks again for being with us on this special edition of Bloomberg Daybreak. I'm Nathan Hager. U.S. markets are closed for the Memorial Day holiday, but the roads, rails, and airports most certainly are not. Of course, Memorial Day marks the unofficial kickoff of summer travel season. And to hear the folks at AAA tell it, this could be one of the busiest travel weekends since they started keeping track more than 2 decades ago. That pent-up demand post-COVID could be ready to burst big time, even with inflation and interest rates sticking with us through these warm months. So who better to help us stretch that travel dollar as we make our way through summer than the points guy himself? Brian Kelly is with us. Brian, thanks for taking time out for what I am sure is a very busy time for you.
Of course. Thanks for having me.
So you were calling last summer the summer of domestic travel. This year you say it's going to be the summer for international travel, even with prices where they are?
Yeah, when you actually look at the prices, and I've been booking a lot of European trips this summer, especially in business and first class, there's actually a lot of great deals out there. There's an interesting dynamic going on in the marketplace. The airlines have actually upgauged a lot of routes, adding more capacity to Europe than we've seen before. There's about 300,000 more seats that the U.S. carriers will have to all of Europe this summer. So it's had an interesting impact on prices. We have not seen the spike in prices that would go along with the increase in demand. We're also seeing now more increased competition from lower cost carriers. And broadly speaking, 2 summers ago, especially when the world really started to open up, we were seeing, not as much demand, but such less capacity that prices were, I was seeing routinely $5,000, $6,000, or $7,000 round trip business class tickets from the U.S. gateways to Europe. This summer, I'm looking at $3,000, $4,000 fares from the West Coast for majority of the summer. And some airlines like British Airways are even having $4,000 for first class round trip to Europe, which I'm kind of shocked by.
Yeah, not terrible. So the airlines are providing the capacity. What has you thinking that they're going to be able to fill those seats?
It's an interesting question, and I think why we are seeing prices not through the roof. There are certainly some routes that you'll see increased pricing, specifically Paris. The thing about Paris you have to worry about this summer, I was actually just before chatting with you, looking at a June trip. The Olympics start at the end of July. So, really end of July and August, Paris, gird your loins and prepare to pay through the nose. But sure. I was looking, flights in June were much higher than normal. But what you really need to look out for is hotels, man, especially luxury hotels. This is where I'm seeing real inflation stay. We're seeing those 2023 numbers, 2022, when hotel rates, the average luxury hotel used, $700 used to be able to get you a nice room at a Four Seasons. That's now $1,700. And in Paris, if you like luxury hotels in Paris, the new norm is 2,500 to 3,000 euros a night.
Wow.
For those top 20 hotels. And it seems to be persistent all summer long. So this is the summer where it behooves you to look outside the box. There's still plenty of affordable, beautiful destinations in Europe that are not Amalfi Coast, south of France, Greek islands.
Yeah, I mean, some of those places obviously are going to be high demand, not just because of the Olympics in Paris particularly, but we've had the Taylor Swift Eras Tour going there as well. It makes you think that maybe August, early September might be the best time frame to go to the City of Lights. But what other destinations are you looking at where we might be able to stretch that kind of strong dollar that we still have given where rates are right now?
Absolutely. The U.S. dollar is still a beast, no matter how you look at it. I was just in South Africa. That's a perennial favorite for me. Of course, you notice, with Argentina, even though they're trying to turn their currency around, huge value to be had. Now, just note, obviously, our summer is their winter. But, winter in Buenos Aires is not like winter in New York City or Chicago. So you can still have incredible travel experiences, less crowds, than going to Europe in peak summer months. And I'll just tell my fellow Americans out there who haven't been to Europe in a while, especially with sweltering heat records constantly, I foresee that again this summer. I was in Florence 2 summers ago when it was in the 90s. And when I tell you a lot of these European cities are not equipped for the level of heat they're about to see. And you see restaurants, the air conditioning units petering out. And it's just hot on the street. So be careful booking, in Europe, peak dates in July and August, because you're not going to get the greatest experience. Also in August in Europe, a lot of the locals leave. So you're going to be paying a premium to be sweating with fellow Americans, which sort of defeats the purpose of going to get the European experience.
Yeah.
But
It's pretty difficult, a pretty difficult time all around in Europe anyway. I mean, given where the geopolitics are in some ways, and a lot of what you mentioned. I mean, we've seen like wildfires last year. I mean, are you thinking like other than some of those more obvious events that are happening in Europe right now, that maybe some of the more off the beaten path travel destinations might just be a better bet all in all, given what the dynamics are in Europe right now?
Absolutely. And this is, I think, a great time to talk about travel insurance too. I've never really been a big travel insurance person. Most of the time with our credit cards, you get basic coverage if, something crazy happens, your flight gets canceled. Even now, due to weather delays, you can get good protections if you've got a premium travel credit card. But what people don't realize is, for example, Maui, when Maui had those wildfires that appeared out of nowhere, you're not going to get refunded from your hotel. Most of the hotel chains did not refund their customers. And I actually think it's a wake-up call for consumers. When you're buying travel, it does not come with protections from these events. And you should not expect, especially if you're staying at a boutique hotel, you should not expect that small hotel owner who's going to go through a horrible financial time to also underwrite the risk for you and your room. I think in America, we've got this sense of, well, if I don't get what I paid for, I deserve a refund. But in these cases, especially strikes are happening all over Europe. When a strike happens, even your credit card may not come through. So more than ever, paying 5 to 10% of the total cost of your trip in travel insurance to give you the peace of mind. And now, to your point, going to some of the more far-flung destinations where you're going to get a better experience. I love Africa. Africa in the summer, certain African safaris, the Great Migration happens in June. I've done that in Tanzania and Kenya. Absolutely spectacular. These are the trips where you might want to invest in that comprehensive travel insurance, and especially if you get sick. I just, did a piece on, I got food poisoning recently.
Ooh.
Luckily, it wasn't so bad, but I've had thousands of comments from my followers who have said travel insurance is a godsend when you're abroad, because most American insurance, health insurance does not cover you abroad, and the credit card coverage is shaky. So my final point on travel insurance, I'm not paid by any one travel insurance company, is never get it through your airline or hotel. Always go. There are sites like Insure My Trip where you can compare and contrast and price match policies. But never just buy a policy one-off from a travel provider because it's easy in the point of sale. Always look. But you'd be surprised. Even if you get laid off from your job, travel insurance will let you cancel your trip and get all your money back.
Yeah, to your point about the Africa experience, we've been doing a lot of reporting at Bloomberg here as well about how a lot of countries in Africa are starting to invest a lot more in sort of that luxury safari experience as well. But when you're talking about higher hotel prices, advising people to get insurance, the costs start to add up, don't they? So, I mean, how do you stretch that travel dollar if you're going to be running into, pretty elevated costs once you get to your destination?
Absolutely. So say you're still hell-bent on going to the Amalfi Coast, right? I get it. A lot of people are. Most of those hotels now, because there's such high demand, not only are you paying 2,000 euros a night or more, they're non-refundable months in advance. And this is a risky game. So, well, first off, and that's where I would say travel insurance, that paying the extra 5% to give you the peace of mind, say you, your spouse, kid gets sick, it's covered, you'll get that money back. That's when it really starts to make sense. But back to your point of how to save, there's still incredible points deals. Air France has been the star of the show this year. If you ask any frequent flyer in the know, Air France has released more 50,000 point business class awards from major U.S. cities across the country to Europe. You can find $50,000 one-way business class flights, and if you compare that to the American Airlines, Delta, their partner, for the same flights will often charge 500,000 miles or 400,000. So there's been this huge inflation in the U.S. airline currencies. The international airlines are where the tremendous value is. I love the Flying Blue program. It's a transfer partner of all the major credit card companies. So my one tip there, too, is don't just put all your miles with one airline. I know even if you fly the one airline, you want to be loyal. What happens is when you just get that co-branded card for that card, you're banking up in a currency where it could, the inflation could go through the roof. And actually, the U.S. government just had a hearing on airlines being naughty. And, they're issuing these frequent flyer miles. And then just continuously, year over year, they'll double the amount of miles you need to go to Europe. The international programs are where it's at. And they often have transfer bonuses from Amex and Chase to Flying Blue, to Aeroplan, to Virgin Atlantic. So become an expert on these foreign frequent flyer programs. And there's a whole new crop of tools that will, like when you buy a flight, Google Flights, google.com/flights is where, you should go to start your flight search when you're going to pay for a flight. Well, say you've got a lot of different Amex and Chase points and Delta. It's really confusing because historically, you have to go to each and every one of those websites to see what they're offering for points. But now there's a site called Point Me. So the website is point.me. And it's basically like Google Flights, but for your award miles. It'll pull in a ton of options for all the different airlines so you can compare and contrast. Oh, hey, maybe I should use my United miles on this flight. Or actually, American has a much better deal. It'll pull it all together on one screen, which can help you get the best value on flights. So when you have to shell out for hotels, hey, look, if at least the flights are free, that is a tremendous savings for your travel budget.
Thanks for this, Brian. Really great having you on with us.
Thanks for having me. Safe travels.
And to you, that's Brian Kelly, the Points Guy, with us on Bloomberg Daybreak. Our thanks to the Points Guy founder, Brian Kelly. And we also want to thank BNY Mellon's Alicia Levine, Invesco's Brian Levitt, and Bloomberg's Michael McKee and Anna Wong. Thanks as well to you for joining us on this special edition of Bloomberg Daybreak. It's 59 minutes past the hour. I'm Nathan Hager. Stay with us. The top stories and global business headlines are coming up right now.